Welcome to the deep dive. Today you gave us a really specific assignment. We're breaking down an extraordinarily optimistic forecast for the 2026 housing market.
That's right. And we're zeroing in exclusively on central Indiana.
We're diving into excerpts from Cara Conde's analysis, and it makes this really bold claim.
Oh, a very bold claim. The idea is that the Indianapolis area isn't just recovering, it's actually poised to substantially outperform the National Association of Realtors, the NAR's national forecast.
So the mission for you, our listener, is pretty clear. Is this local optimism justified? We're going to pull out the specific data points, the economic drivers, and the strategies that support this prediction.
A prediction of 15 to 18% sales growth.
Which would just crush the NAR's national number of 14%.
Exactly. So to set the baseline, let's quickly establish what the nation is doing.
Okay.
The NAR is forecasting a pretty substantial comeback. It's centered on existing home sales, and they're expecting a jump from about 4.02 million units to 4.60 million nationwide.
I mean, that 14% increase, that's a huge number. That would be the first double-digit sales jump the country has seen since, the boom of 2021.
That's it. And the engine behind that national jump, it's largely a psychology shift.
Driven by interest rates, I assume?
Driven by interest rates. The forecast points to what they're calling 1.8 million locked-in homeowners.
Right, the people who are stuck with those amazing sub-5% rates.
Exactly. And the thinking is they are finally going to re-engage with the market as rates continue to, moderate.
And that national moderation is expected to be significant, but maybe not dramatic. The NAR is projecting the 30-year fixed mortgage rate will average right around 6.0% for 2026.
Which is down meaningfully from the 6.7% average we saw in 2025.
So that gives buyers a bit more purchasing power.
It does, but it also creates the urgency needed to finally start addressing all that pent-up national demand.
Okay, so that's the national context, but we're here for central Indiana. A predicted 15 to 18% sales increase is... well, it's massive.
It is.
Given that so many national markets are still struggling to find their footing, is there a risk that this local optimism is leaning too heavily on just, a few economic factors?
That's a critically fair question, and the source material, it actually addresses it head-on. It points to current performance and some very distinct local advantages.
Okay, so what's the first one?
The data. The numbers from IBOR, that's the Mid-Indiana Board of Realtors region, show the local market is already accelerating much faster than the national average.
Give us the specifics on that. How much faster are we talking?
Okay, so for the fourth quarter of 2025, closed sales were already up 11.4% year over year.
Wow.
But here's the fascinating part. The forward-looking indicator, pending sales, they were up a staggering 18.7% year over year.
So that pending data suggests the volume for 2026 is already primed to just blow past the national curve.
It's already baked in to some extent.
And if we're talking about volume, we have to talk about inventory. It's the key tension point everywhere. But central Indiana seems to have an extreme scarcity problem that really makes it an outlier.
Absolutely. The scarcity is one of the biggest reasons for these higher appreciation forecasts. I mean, while many metro areas are hovering around 3 or 4 months of supply...
which is already low.
Right, already a seller's market. Central Indiana's total inventory sits at just 1.8 months. The source states that's half the national average.
Half. So the competition for every single home is just geometrically higher here.
That's the perfect way to put it. And that scarcity sets the stage, but the true differentiator for Indy, well, it's the incredible flow of high-wage jobs. Let's talk about those corporate super boosters.
Yeah, let's.
We aren't just talking about another corporate relocation. We're talking about foundational economic shifts.
You mean Eli Lilly?
For one, yeah. Eli Lilly's $14 billion+ expansion, that is a radical shift in the demand curve for the entire region.
And it's not just them.
No. You add Amazon's second HQ2-style robotics campus. And on top of that, you have this continued steady flow of corporate relocations coming in from places like Chicago and California.
Higher cost environments.
Exactly. And that influx drives demand not just for housing, but for luxury homes, for top schools, for infrastructure. It ensures this market strength almost regardless of national headwinds.
That context is just crucial. These aren't typical job growth numbers. This is a massive injection of both people and wealth.
And if we connect that job growth back to the critical tension point inventory, we start to see who's really feeling the pain from this boom. That 1.8 months of supply, it's incredibly deceptive because the pain is not spread out equally across all the different price bands.
Okay, let's break down that MIBOR data from November 2025. If you are a first-time buyer trying to get into the market, the news is pretty grim.
It is. If you look at properties priced under $300,000, inventory drops to a shocking 0.9 months of supply.
Under 1 month.
Under 1 month. And to put that in perspective, anything under 4 months is a strong seller's market. Under 1 month is an extreme seller's market. Homes in this price range are basically evaporating the second they're listed.
So under 300K, that's where the velocity is highest, and the selection is basically zero.
Pretty much. Then you move up to the $300,000 to $500,000 band, which is that critical range for move-up buyers. It's only slightly better at 1.6 months.
So still incredibly competitive.
Oh, absolutely. The only segment in the entire MIBOR area that is even close to balanced or, normal is the 750,000 plus tier.
And what's that at?
It's sitting at 4.2 months. But even that high-end inventory is shrinking fast as all those high-wage earners relocate into the area.
So if existing homes are this scarce, especially at the entry level, we have to ask, can new construction save the day for first-time buyers?
This source suggests no, or at least not yet.
Why not?
Builders are still really cautious after the turbulence of the past couple of years. The economic reality is that most new construction that's coming online, it's targeted at the $500,000 and above price point.
Which does very little for the buyers who are desperate to find something under $400,000.
Exactly. It just compounds the problem for that whole entry-level segment.
And this shortage, it just underscores why mortgage rates become such a huge psychological factor. So let's look at the expected rate path for 2026 based on that Fannie Mae and MBA consensus.
Right. So the rates are expected to moderate consistently through the year, but they're not going to collapse. We'll start Q1 2026 somewhere around 6.4 to 6.6%.
Okay.
By the time we hit the second half of the year, Q3 and Q4, the rate should settle into that 5.9 to 6.1% range.
The downward path definitely motivates buyers,
Right.
But the source material gives a pretty strong don't wait warning. Why is timing so critical even if rates are falling?
This is a crucial point. The translation the analyst provides is that buyers who hold out, hoping for those sub 5% rates from the pre-pandemic days,
They're going to miss out.
they're likely going to miss the best selection, the best homes, the ones in the best school districts. They will be sold during that early 2026 buyer frenzy when rates are still a little higher.
So if you wait until the end of 2026 for that 5.9% rate,
You are going to be right back in that desperate multiple offer competition for severely limited inventory. The message is pretty clear. Prioritize selection over trying to time the absolute bottom on the rate.
Okay, so given this tension between all this corporate demand and the extremely tight inventory, let's zoom in on the submarkets. Because real estate is always local.
It is, and the segmentation is vital because it shows exactly where that influx of wealth is causing the most aggressive appreciation. Let's start with the high-end growth market.
So Carmel and Westfield, they're synonymous with, high quality of life, top schools.
And their median price is projected to rise from its 2025 level toward $595 to $625.
That's a projected jump of 9 to 12%.
It is, and those numbers directly reflect the movement of those higher-wage tech and pharma employees. It's a direct correlation.
And what about Zionsville?
Zionsville, which is already the luxury leader, is forecast to jump 9 to 11%. That's pushing its median price up to between $745 and $785.
And that growth is attributed to what?
Continued demand from downsizing luxury buyers, people selling their huge suburban estates but who still want to stay in a high-amenity area.
Okay, moving into the mid-range, which for Indy is rapidly approaching that $500,000 mark, we're looking at Fishers and Geist.
Right. Fishers and Geist are projected to see 8 to 10% appreciation. That moves the median from around $465 up toward $5 to $530.
And the source connects that to something specific.
It does. Specifically, the new Geist waterfront developments, which are really increasing the local desirability and driving up all the valuations in that area.
Given the incredible pressure on the lower end, we have to zoom in on where first-time buyers are actually finding refuge.
The value and first-time focus markets.
Exactly.
So the areas benefiting most from that Lilly ALEP campus expansion are Avon and Brownsburg.
And they're slated for one of the highest appreciation rates.
10 to 12%, pushing their median right up towards that $400,000 mark. This is just a perfect, explicit example of corporate jobs directly driving up prices in the suburbs right next door.
And Greenwood and Center Grove, known for that great combination of relative value and good schools.
They're projected for a very solid 8 to 10% jump, reaching somewhere between 385 and 410.
So the key takeaway across all of these submarkets is that appreciation is pretty much uniform. There's no sign of a plateau, let alone a crash.
Not at all. The tide is lifting all boats.
Seeing those numbers and that velocity, let's synthesize this into some actionable strategies. What should different people be doing with this 2026 forecast? Let's break down the playbooks.
Okay, for first-time buyers, the message is urgent. That window for sub-$400,000 purchases is closing, and it's closing fast.
So the playbook is to target those specific value areas we just talked about, Avon, Brownsburg, Greenwood, and be ready to jump immediately.
Immediately. And crucially, the source highlights a major financial tool that's available right now.
The Indiana Housing Next Step program.
Exactly. It offers up to $15,000 in forgivable down payment assistance.
Yeah.
In a market moving this fast, that kind of financial cushion is essential for an entry-level buyer.
Okay, now for the move-up and luxury buyer, what's their focus?
Velocity. It has to be velocity. The fastest appreciating segment identified is Carmel and Fishers in that $750 to $1.5 million range.
And the speed there is staggering.
It is. We're talking about off-market, pocket listings in this luxury tier that are reportedly closing 10 to 20% above the list price because of the competition.
That kind of bidding war at the high end just shows the sheer purchasing power that's moving into the region. So let's talk investors chasing cash flow and returns.
The source details several tailored strategies here. For buy-and-hold investors, the recommendation is to focus on 3-bedroom ranches in Brownsburg and Plainfield.
And why there?
The source cites the potential for instant equity appreciation, plus a projected 8 to 10% rent growth, all driven by that expanding workforce.
And what about more specialized investment vehicles?
The analysis points to 2 key areas. 1, focus on Lebanon for new construction duplexes. That's a play entirely driven by future Lilly-related rental demand.
Okay. And number 2?
The source notes that 1031 exchange investors are moving specifically into single-family rentals in Hendricks County.
That's the mechanism that lets them swap real estate assets tax-deferred.
That's the one. And they're targeting initial cap rates of 6.5% to 7.5%.
And just to quickly define that for listeners, the cap rate is basically the annual rate of return you can expect on a rental property, not counting your mortgage.
Right.
The fact that investors are accepting 6.5 to 7.5% suggests they're anticipating that significant appreciation is going to boost their total return down the line.
Exactly. They are betting on this market appreciating faster than almost anywhere else in the country.
Finally, for sellers who want to maximize their returns, the forecast even identifies specific windows of peak buyer frenzy in 2026.
It does. The primary window is February through April. That's when you capture all the buyers who are rushing to lock in their selection before rates drop any further.
And there's a second wave.
A secondary wave in September through October. This is driven by buyers who waited out the summer or maybe new corporate relocations arriving before the new school year starts.
Okay, so let's tie this all together.
To quickly recap the main insights from this deep dive. The source material provides a really strong case that central Indiana's fundamentals, that chronic undersupply, the massive corporate investment, robust job growth, all of it will drive continued appreciation and sales velocity far above the national average in 2026.
And the analyst even labels 2026 as one of the best years to buy in a decade.
Because of that unique intersection of falling interest rates with what might be the peak velocity of available inventory before things get even tighter.
It's a compelling narrative of local economic strength.
Yeah.
But if we connect this all back to that initial tension point, the extreme scarcity, this raises a final crucial question for you, the listener, to think about.
Right. We saw that new construction is overwhelmingly focused on that $500,000 plus segment. And at the same time, inventory under $300,000 is critically low at 0.9 months of supply. So the question is, how long can this immense influx of high-wage job growth from Lilly and Amazon sustain demand without creating a true non-negotiable housing scarcity crisis at the entry level?
And if that scarcity persists or gets worse, Will that pressure push those predicted appreciation numbers in the lower price bands, the Avons and Brownsburgs, even further upward? Could their 10% appreciation forecast actually look conservative before any meaningful inventory relief can arrive in, say, 2027 or 2028?
It suggests the market tension might get significantly worse before it gets better.
A critical tension indeed.
And one that really highlights the need to constantly monitor that MIBOR inventory data all year long.
Absolutely. Thank you for sharing your sources and letting us unpack this fascinating forecast. We will catch you on the next deep dive.